Hello, I'm Eric. This is Nick. We're back again for part 2, permanent insurance. Nick?
All right. Yeah. So as I had said at the end of the last Financial Tip Friday regarding term insurance, permanent insurance is a whole nother conversation because there are any different situations where you would be using it. Oftentimes, people look at it as a cash value accumulation vehicle, and it certainly is not the wrong answer unless it's being used in the wrong context. When I look at cash value life insurance in the planning scenario for my clients, I'm looking at, are you already maxing out your 401k? Are you either maxing out your Roth contributions every year, or do you make so much that we need to be doing backdoor Roth contributions? Are you maxing out your other investment opportunities? Because the investment opportunities in the market come with the lowest cost of investment. When you're putting money into the market, $100 a month, you're putting money into the market. There is maybe an advisory fee or a commission associated with that, but you're putting the most you possibly can put in the market. Where with life insurance, you have what we refer to as insurance drag. There's that cost of insurance first, that must be satisfied. And then the money outside of the cost of insurance that's inside of that premium goes into that accumulation potential. With whole life, so that's one type of permanent insurance, whole life. You've probably heard of that the most. You're paying premium, and then it's usually through a mutual company, so you are a mutual owner of the company, and you're getting a dividend ratio based on the amount of premium you're paying. And that dividend is what generates the cash value. Every year, there's a guaranteed value and a non-guaranteed value. Every year, on your policy anniversary, you get your dividend, which accumulates cash. It is probably the most expensive, this is speaking in general terms, the most expensive permanent insurance. There may be a scenario where we would look at whole life being the right answer for a planning case. But if you're looking for the most amount of coverage for the least amount of dollars, that's not whole life. That's term insurance, as we mentioned before. Clarifying whole life. You pay the premium, the policy is in force. You stop being able to pay the premium or just decide to stop paying the premium, there could be some consequence to that that's negative that you don't want, like the policy could lapse, and the policy could lapse and cause a taxable event, which you want to prevent. But typically, with whole life, very basic design, you pay premium, policy stays in force for the duration of the time you paid the premium, and at your death, it pays out. Universal life is another type of permanent insurance. Universal life is more flexible. So flexible premium design, flexible face amount, flexible premium duration. Where whole life, you typically have, you pay for the duration of the policy or until age 65, or some other very specified duration of time. The carrier that creates the insurance product has a very specified rule set for how long premium should be paid on whole life. With universal life, whether that's universal life, that's a current assumption, meaning this policy is getting like a 4% rate of return, variable universal life tied to the stock market, and then index universal life, which is tied to specific indexes and is not a variable product. And I can get into more detail on each of those, but you can specify the face amount and you can change the face amount. The premium is specified at the policy issue, but you can also change the premium. The basic definition of universal life is flexible premium, flexible face amount, and flexible payment duration. And there are scenarios where each of those makes sense. The most common is people are looking at them as a cash value accumulation investment, if you will. It's not an investment, it is life insurance. But again, the cost of insurance drag prevents the most amount of dollars going into the cash accumulation. A lot of cases where you see permanent insurance being used is estate planning. So at some point, we are all going to die. At some point, we either want to leave a legacy or we don't. And in some cases, it makes sense to use life insurance as a part of that estate planning, that legacy building, because it passes to the beneficiaries or to the estate as a non-taxable event. Buy, sell, succession planning, farm succession planning. You've got multiple partners or multiple family members that are part of a business, and you only want to do business with each other, the people who are actively involved in the business, and you don't want to do business with people outside the business but have a vested interest in that partner, like a spouse. So if Eric and I were in business together and I want to do business with Eric, Eric wants to do business with me, but I don't want to do business with Eric's wife and he doesn't want to do business with mine. We would have policies on each other that we would own. He'd be the insured, I'd pay the premium, and if he dies, I get the death benefit. That makes me a whole owner of the business, and then his spouse, I pay out the interest that he had in the business. So if he was a 50% owner, I've got the life insurance benefits that help me pay out a taxable event to his spouse. That's business succession planning in the summary, and that's what we use life insurance for. And you can use term insurance for that, but it might make sense to use permanent insurance for that as well. There's that flexible element of how long are we going to do business with each other what if it's longer than a 20-year term policy? So there's a lot of different designs to use permanent life insurance. There are several different, as I mentioned. It's kind of infinite in the amount of ways we use life insurance, and you might need to use a permanent policy. The basic premise is permanent insurance, any type of permanent insurance, you pay the premium, the death benefit is there until you stop paying premium or you die. Now, you could stop paying premium and there might still be some insurance left over afterwards because of the cash value, but basic design, you pay premium, the policy is there until the day you die.
Good. All right, so as you can see, just from this basic conversation of 4 to 5 minutes, there is a lot to talk to and discuss when it comes to life insurance. So it's best when you have these type of needs that you talk to somebody that can be beneficial in answering these questions for you. So if you need any help with anything, feel free to come and see me and Nick, and we would be happy to do so.